So first, you want to start off by just once again, just thanking our 2020 partners for this year: HyperChat Social, Community Foundation, Fairway, Heinz, T. Rowe Price, Charles Schwab, Thrivent, Benefit Street, DPL partners, TD Ameritrade, Vanguard, and My 529. Thank you so much for all of our 2020 sponsors for this year. A quick announcement: we're going to have an amazing event. So please join us October 9th at 4:30 p.m. We're going to have the Tale of Two Approaches. It's going to be an after-hours discussion with Vanguard and DFA. We're going to be talking about the great question right now: value versus growth, passive versus active, mutual funds versus ETFs. And we're going to have two great companies up there giving us their unfiltered thoughts and giving it to us raw and straight. We can't thank both of our sponsors so much for this great opportunity. We've been having a lot of questions, a lot of people signing up, a lot of questions. So please visit our website. This also is a great segue. Vanguard is one of our sponsors for today. Steve Simons and his team over there in Vanguard, they've been amazing partners to our organization here for FPA of Georgia. We can't thank them enough. And I guess without further ado, we'll go ahead and play their sponsor video for this week. So let's go here.
Client first is really the ethos of how we operate day to day. We want to make sure that we are delivering performance that's commensurate with what the client is expecting from a risk standpoint, a performance standpoint, and ultimately their goals standpoint. So when we think about our investment philosophy, much of what we do is trying to look through the short-term economic cycles and really focusing on what's in the best interest of our clients over time. And a big part of our strategy has always been focused on discipline, risk control, but also that long-term approach to investing. We have really tight tracking on the index portfolios, both in fixed income as well as equities, and top quartile performance when it comes to our actively managed funds on the muni side, on the taxable fixed income side, or even on the quantitative equity side. Our investment teams are highly specialized, and much of that expertise is backed up by a globally integrated team with investment locations in the US, Europe, and Asia Pacific. And we manage these portfolios using a collaborative approach. We're getting the very best thinking from people around the globe. All of our efforts are singularly focused on our clients. That means that as we get better at what we do, and that's our aim every single year, that value that gets created goes back to our shareholders, and that makes us very, very unique.
Amazing, amazing. Once again, if you, there we go. All right, now we're done. So once again, if you're looking to learn more information about Vanguard, please contact Steve Simons and his team and AJ, a wonderful group over there. Once again, we can't thank them enough for all the support that they have given us here for FPA of Georgia. Steve, I'm not sure if you're out there. I can't see right now, but thank you guys so much. And we look forward to October 9th. We're very, very excited about that. So without further ado, let's go ahead and introduce our speaker for today, Jeffrey Levine. I'm not going to sit here and read all those designations. You guys can see that there. The list goes on and on. But Jeffrey Levine is the Director of Advisor Education for Kicksis.com, Director of Advanced Planning at Buckingham Wealth Partners, and is the lead creator and content expert for Savvy IRA Planning, offered through Horse's Mouth. Jeff is a recipient of the Standing Ovation Award presented by AICPA Financial Planning Division and was named the 2017 class of 40 under 40 by Investment News. Previously, Jeffrey served as Ed Slott's and company's chief retirement strategist. I didn't know that, Jeff. That's really, really cool. Where his ability to simplify the complex laws that govern individual retirement accounts, combined with his unique blend of humor and tax planning, was first recognized. And I think he kind of bridges that over to LinkedIn as well, too, because he keeps me thoroughly entertained over there. So Jeffrey continues to be an active speaker, traveling the country each year to educate thousands of financial advisors, CPAs, attorneys, and consumers on retirement, tax, and estate planning strategies. You can follow Jeff on Twitter at CPA Planner and also on LinkedIn and other platforms and via his personal website. Without further ado, Jeffrey Levine. Oh, you're on mute there, Jeff. You're on mute. There
You
you
know,
go.
this is only the 7th presentation I've done in the last 3 days. You'd think I would remember that by now. Rookie move, rookie move, rookie move. All right, good afternoon or good morning, everyone. And thanks for the opportunity. Thank you, Malik, for the introduction. Thank you for the opportunity to speak with you all today about a bill that came out of nowhere, a $2 to $6 trillion bill, depending upon how much of the loan we want to consider as part of the total proceeds. I mean, just a massive stimulus package. And I really probably at some point should update this title and call it beyond just CARES Act, new rules, new planning and strategies and opportunities, but CARES Act and all the related nonsense that came after it, because we've had bill after bill after bill, things like the Paycheck Protection Program Flexibility Act. We've had IRS guidance via notices and revenue rulings. And so really what we're going to cover over the next 50 minutes or so is an update on the CARES Act and all the things related to the CARES Act that have come out since, so that you're in the best position possible to guide both your individual clients as well as the small business owner clients going forward. And I'll just go ahead and share my slides here. And Malik, if you get a chance and you could just let me know you see the slides, everything is good?
Everything is good.
Beautiful. All right, so we will get going and we'll kind of break this into different pieces. And in each area, I want to focus on the things that are most important today. I will say this, I have never written or talked about so much in my entire life that so quickly has been either irrelevant or just wrong because they've changed the rules. And so what I want to spend our time on is what are the most relevant things we need to know about today. So for instance, when we talk about the recovery rebates, what are the most important things? Because most of your clients, if they are to get one this year, they probably already received it, right? So we don't need to spend our time talking about how is it calculated, et cetera. If you want that, then there's information I can give to you. Notably, if you look at the bottom of each and every one of these slides, there's a little link. It says kitsis.com/FPAGA20. If you go to that site, not only will you be able to download all the materials from today that you see here, but there's also additional reading material related to the CARES Act that we've kind of put together for you as well. So things like how the recovery rebate stimulus checks were calculated, that's in there. But what I want to do is cover the things that may still be common questions that you will receive from clients. For instance, some clients may say, yeah, but my 2019 income was really low, or my 2020 income was really low. Why aren't I getting a rebate check, or will I get one in the future? And the good news for those clients who have low income this year, and obviously that's not the good news, but the good news is that even if they didn't get the recovery rebate already, they will actually get the credit when it's issued, when they do their 2020 tax return next year. So the way the credit actually worked was Congress paid it initially based on either 2018's income or 2019's income. And for individual filers, that recovery rebate started to phase out at $75,000 of income. For married couples, it was $150,000 if they filed a joint return, and heads of households were right smack in the middle at $112,500. But as income began to exceed those amounts for the most current year on file, clients lost the ability to receive those recovery rebates. So for instance, a client who had 2018 income of $200,000, well, they would not have received a recovery rebate if their 2019 income tax return had not yet been filed, because the IRS would have said, hey, we're paying it based on the most recent information we have available, that's 2018. Similarly, if they file 2019's income tax already and it was too high, they would not have received it. But look, many people are struggling this year more than ever before. I can imagine that many of your clients probably are experiencing things that they never expected to experience in their life, never did before. Personally, I've spoken with a number of my clients where this is the first year that they have ever in their lifetime received unemployment benefits. And so they are, incomes may be dramatically lower in 2020 than they were in previous years. Unfortunately, because of that, the way the credit was paid it was paid again based on prior year's income, but it's really a 2020 credit. So if their income, if your client's income this year is actually low enough to qualify, so they're a married couple filing a joint return and they make less than 150,000, or they're a single filer and they make less than 75,000 this year in 2020, then even if they didn't get the recovery rebate before because their income was too high, they will get it this year. They will get it when they file their tax return, and either it will increase the amount of their refund or it will decrease the amount that they would otherwise owe. So clearly, look, there are some very easy scenarios here. There's the client had low income before, client continues to have low enough income today. Well, then clearly they would get the credit. And that's kind of what we see in the top left quadrant of this chart. In the bottom right, we see clients who had high income before this year and continue to have high income this year. And again, very seamless, very clear, they will ultimately not get the credit because their income was never low enough. What is kind of more unique, though, is that group on the bottom left. Those are those with high income in the past who this year had lower income. And again, there they will receive it when they file their return. It's a very common question. Another common question we're seeing from clients is some of them are having the opposite situation where their income was actually low enough to get the credit because their 2018 or 2019 income was low enough to qualify. But this year they've had a better year in income and they are actually over the threshold this year and they want to know, well, will we have to pay that back when we go and file our return next year? And the answer there, surprisingly, is no. The way the CARES Act worded it, it said that if we pay you a credit based on your old income and you receive that credit, and then this year your income is actually too high to really qualify, we're just going to chalk it up to being a math error. That's what the bill says. We chalk it up to being a math error, and we will proceed from there. So that's a really critical element of the rebate checks that is still up in the air. Some other things to consider here are, what about clients who may need to return those checks? I know some clients have received checks that they actually can't keep. For instance, if a dependent received the check, they need to return that. If they don't, they're going to be responsible. They're going to get a letter in the mail, probably from the IRS at some point in the future saying, hey, we sent you this money incorrectly, send it back. And you might say, well, Jeff, I thought you just said that they'll chalk it up to a math error. What's the deal? Well, it's only a math error if it's paid based on income that was low enough before but too high now. But if you're not eligible to receive the credit at all, but one was sent to you in error, then you cannot keep it. And so one of those individuals would be a dependent. And you might say, well, Jeff, when does a dependent, how would the dependent even get the credit? How does the IRS know? Well, think about your clients with maybe children who are 16 or 17 years old. Maybe they work a summer job. And they had income last year. So they filed the return. The IRS had that return on file. And in the haste of trying to get these checks out, many of those children received that recovery rebate check, and that does need to be returned. Similarly, there are situations where an individual received a check for someone who was already deceased. The way the IRS FAQs on the website read, and you can see the link there on your screen, the way the FAQs read, it says, if the check was received after the person died, then the check needs to go back. So that could be someone who died early this year before the rebate check was issued and the executor got it for that person. It could even be a situation where a married couple was both alive at the start of this year. Maybe one of the spouses died in February, and the survivor got a check now for both of them of $2,400 instead of $1,200. Well, the excess amount attributable to the deceased spouse, even though they were alive at the start of this year, needs to go back. It's one of those wrinkles in the law, and candidly an interpretation that the IRS came up with that many people disagree with. But until we hear otherwise, that's what needs to happen. And then there are other situations where you say, surely the check has to be returned, and yet it doesn't. So a common one there would be the situation for divorced parents. So some divorced parents, you may be familiar with this, in an effort to kind of compromise from a tax perspective, it's a odd and even type situation of claiming the children. So spouse number one or ex-spouse number one claims the children in even years, ex-spouse number two claims the children in odd years, etc. And it's possible then that one spouse claimed the child on their 2018 return, had not yet filed the 2018 return. And so the IRS sent a recovery rebate check, not only for the individual filer, but also the extra $500 amount for their young dependent under the age of 16. It's also possible that the other ex-spouse did file their 2019 return early enough and claimed the same child and got another $500 attributable to that same child. And you'd think to yourself, well, surely they must have to return that extra $500. That, maybe the parents split it, or maybe one of them keeps it. No, they actually both get to keep the full $500. Very surprising. If you're wondering, can my client keep the check? The best place to go is in those FAQs. They'll give you a good summary of those things. All right, moving on. Let's talk about some of the key tax and retirement provisions in the bill. And we'll start with what is still a very important provision, the coronavirus-related distribution. So first off, what is a coronavirus-related distribution? It is a distribution that allows individuals to get a number of tax-related benefits. And it's up to $100,000 combined from all accounts. So you may have an IRA with $300,000 and a 401k with $300,000, but you cannot take 100 from each. It's 100 combined from all of the retirement accounts. And it could be less, but just no more. In addition, it must be made in 2020, but it could actually be made at any time during 2020. So even distributions made on January 2nd this year, well before the first coronavirus case was here in the US, and certainly well before the pandemic really took hold, well, that would still qualify potentially as a coronavirus-related distribution, provided the individual meets the other qualifications, which we'll talk about in just a moment. Similarly, someone could actually take a distribution on December 31st of this year. And as long as they qualify, that still will be treated as a coronavirus-related distribution, which of course begs the question, what do you need to do to qualify? And the easiest way to summarize this is what I like to refer to as being physically or fiscally impacted by the coronavirus pandemic. You are either physically or fiscally impacted by the pandemic. So the physical, meaning that you, your spouse, or a dependent are diagnosed with a positive COVID-19 test. And I have been asked by some people, well, I know we had it early on because we had all the symptoms, everybody else had it, but I never got a positive test. Does this still work for me? And the answer there is actually no. You do need a positive test. Even if testing wasn't available, if you don't have the test, you can't qualify on the physically impaired side. But you might still be able to qualify based on the fiscal impairment side. And the fiscal impairment side says that either that you've been laid off, that you were furloughed, you had hours reduced, that you were a small business owner and had to either close or partially close, etc. In addition, the CARES Act also said that the Treasury Secretary, read the IRS, can come up with other rules that they want in order to allow individuals to qualify for these distributions. And notably, that's just what they did in Notice 2020-50 earlier this year. In Notice 2020-50 from earlier this year, the first thing they did was they broadened the scope of individuals who can take a coronavirus-related distribution by saying, if any of those fiscal impacts not only happen to you, but to your spouse, it's okay. Because what they were finding was some people were laid off, their spouse might have been laid off, but they were the ones with the big IRA or the big 401k, and they wanted to take a distribution from their own IRA because they needed to make up the spouse's lost income. Well, the CARES Act initially said, you are furloughed, you, the taxpayer. The notice in the guidance in Notice 2020-50 expanded that. So now it's not only you, but also you, your spouse, or someone else in your household, a member of the household. In addition, it further expanded the list of fiscal impairments to include a job offer that was taken back, or a job that was supposed to start on X date but got pushed back some period of time because of the pandemic, or a scenario where not only hours were reduced, but maybe hours weren't reduced, but your employer just said, look, if you want to keep your job, I'm cutting your pay. You're going from $25 an hour down to $15. If you don't like it, you can leave, but I'm not going to fire you. I'm just lowering your pay. Well, initially under the CARES Act, it was just a reduction of hours, not a reduction of pay. Now it's clear that the reduction of pay applies as well. And by the way, it even applies to self-employed individuals. So if there is a material impact to the self-employment income of someone, and we can attribute that to the pandemic, which I think in many cases would be the case this year, then that would also allow them to qualify for a coronavirus-related distribution. Which, of course, then begs the question, Jeff, why all the hullabaloo? Why do you care? What's the big deal about a coronavirus-related distribution? Well, there are 5 potential benefits that may be available to an individual who is taking a coronavirus-related distribution. And they may be able to benefit from all 5, or they may choose to benefit only from 1 or 2 or 3, but there are potentially 5. The first one is that for individuals under 59.5, it is an exception to the 10% penalty. So income tax will still apply, but there's no additional 10% penalty, which, look, on a $100,000 distribution, that is a potential tax savings of $10,000. The second key benefit is that unlike normal, quote unquote, distributions from an IRA that are included in the year that they are taken, a coronavirus related distribution can actually be included evenly over a 3-year period. So normally in 2019, for instance, if I were to take $99,000 out of my IRA, well, when I go to file my return, I have to include $99,000 more of income because I took it out of my IRA. With a coronavirus-related distribution, the default will be, instead of including $99,000 on the return this year, we'll include $99,000 on the return for $33,000, 1/3 of that on the return for 2020, $33,000 the next third on 2021, and the final $33,000 in 2022. So by default, it will be evenly spread over the 3-year period beginning this year. And many times that's beneficial, right? Instead of having a large amount of income in 1 year, spreading it out over more evenly over a number of years can be effective. However, there are a few contraindications or reasons to consider not doing that. And a client can actually opt out of that special treatment, and they can opt into the regular tax treatment, including it all this year in 2020. And there are a few reasons they might want to consider doing so. The first is that, well, maybe the reason that they're taking the coronavirus distribution in the first place is because they were really impacted by this virus, right? They were laid off. They were in a situation where their hours or pay was substantially reduced. And so their income this year is very down. Maybe they're a small business owner and they had to close for a few months. You know, as a business owner, you can lose, in some businesses with smaller margins, you can lose 20% of your revenue for the year by closing for 2 or 3 months. And that might be your entire profit margin for the year, right? Like that could mean that you run the rest of the year just to try and break even. So some individuals will actually have much lower income this year than they will next year or the year after, or at least than they will hope to have next year or the year after. And so if that's the case, we may want to opt out of the default treatment and push some of it into next year, and instead opt into the special treatment of including it all this year when it's a low income year. The other thing you may want to keep in mind, and we don't have to decide this now because you won't ultimately decide how you spread that income out until you file the return next year. And obviously by then we will know the results of the election. But depending upon what happens with the election and who retains power, it's very possible that we could see changes to tax policy as soon as next year. Now, it's difficult to talk about taxes and bills like this, et cetera, without talking or bringing up the political landscape, right? It's very tough because the reality of today's situation is that we have two parties that have very, very different ideas as to what tax policy should look like. And so depending upon things like election results, it can really dictate or influence the way we do planning. So I don't think it's particularly, inflammatory or opinionated to say that Democrats have a more progressive approach to taxes, right? It's just fact, whereas Republicans would like to keep taxes a little bit lower. So if we were to see a blue wave later this year in the November elections and the presidency, the House, the Congress were all controlled by Democrats afterwards, well, we could very well see increases to the tax rates as soon as next year. Vice President and candidate Biden's proposals notably call for increases in the tax rates up to 39.6% for individuals who are making more than $400,000, which for those individuals would be an increase in the tax rate of about 7% compared to where they are today. So if you were in that bracket now and you thought to yourself, well, gee, do I want to push it out until next year when it might be taxed higher? Depending upon what happens in the election, it might influence your decision. Again, the good news is by the time we have to make the decision, it will be next year and we will already know those results, and perhaps we will even know a little bit about what the first orders of priority are for whatever administration takes, has power at that point. And so certainly worth considering. Also worth understanding, you say, well, Jeff, can't we always amend the return and go back and figure it out after the fact? And the answer is no. There are some things on a return that when you file cannot be amended. They are irrevocable elections, and this will in fact be one of them. All right, so that's the second key benefit. The third is that whatever is taken out via a coronavirus-related distribution can actually be repaid for up to a 3-year period following the day the distribution was received. So if I get a coronavirus-related distribution, I qualify, maybe I was laid off, and so I take the $100,000 out of my IRA today. And I might want to put that back in. I just don't have the ability to do so now. I can actually repay that distribution for up to 3 years from today and go back and amend my returns and eliminate those tax bills retroactively. By the way, not only would I eliminate the tax bills retroactively, but I'd even get interest on them. Not much today, but you would get something. So it is certainly worth keeping that in mind, that you've got this 3-year period, and it can be paid back in any way you'd like over that 3 years. So if I took $99,000 out today, I could do nothing, and on the 364th day, right before the 3-year mark, I could just write a check for $99,000 back into that account, and that would work. Alternatively, I could take $3,000 out of my income for the next 33 months each and pay it back bit by bit. I could do it in 3 installments of 30. It doesn't matter. As long as I get back the money within the 3-year period, it will be okay. And we don't have to worry about things like the once per year rollover rule. The fourth potential benefit is a employer plan benefit. Normally, when you take a distribution from an employer plan that's eligible to be rolled over, the employer must withhold a minimum of 20%. You've probably all dealt with this before, where your client takes a distribution and they get 80% of it, but 20% was mandatory withholding. Well, in those situations, or in this situation, I should say, Congress was keenly aware that some individuals may need cash flow as quickly as possible, and we may not want to have that 20% be held up in the form of withholdings at this point. They may need those dollars in their hand. And so a coronavirus-related distribution can be taken without any withholdings at all. The company does not have to allow for such distributions, though, so that is worth noting. It is an option of the plan to adopt the ability for clients or participants to use such distributions. And from a planning perspective, if your client does or did choose to take a coronavirus-related distribution this year and they don't have withholdings, well, they are still going to be responsible for the tax, right? So what then? What do you do? So it is worth noting that clients, even if they may have opted out of that or choose to do so before the end of this year, that they are still responsible for the tax, and they need to be aware of that come next year. All right, and then that brings us to our final potential benefit of the coronavirus-related distributions, and that's that the coronavirus-related distribution can be considered its own distributable event. And this applies to all sorts of plans, including, well, defined contribution plans, I should say, including solo 401ks. So what does that mean, that it's its own distributable event? Well, if you think about young clients, let's say they're 45 years old and they are working and they have a employer who sponsors a 401k. You work with them and they say, you know, I really don't love the investments of my 401k, and you're the best advisor in the entire world. Boy, I wish you could manage my account. Can you, if they're still working at 45, can you roll their dollars out and put it into an IRA? The answer is no, usually, right? Because of the ERISA rules. They kind of make sure that the assets remain in the plan until either the individual separates from service, or at the minimum, they reach 59 and a half. Well, there are occasionally limited exceptions, and one of those limited exceptions here is the coronavirus-related distribution. If the plan adopts such a provision, and again, this is an ability of the plan to do this, they can choose to or not to, but if the plan does allow them, then an individual can take up to that $100,000 amount out, even if they would normally not otherwise be eligible to take the money in the first place. So our plan participant who is 45, we just talked about, even if they're still working, could presumably take $100,000 out of their plan and use it for, could even roll it over to an IRA. There would be nothing them preventing them to do that at that point once they got it out. Now, if your clients are looking to do this, but they have not yet updated their particular plan or their small business plan, their solo 401k, et cetera, there is some good news here. The legislation, the CARES Act, specifically acknowledges the fact that, you know, people might be a little bit busy this year with other things going on. And so the company can treat the plan as though it was already amended and the coronavirus-related distribution adopted, but not physically update the plan until potentially as late as 2022. So there's a long runway to actually do the physical updating of the plan document. Clearly, that's enough time, or it should be enough time for clients. And if they want to use a coronavirus-related distribution this year, they can do so as long as they pledge essentially to update and amend the plan by that deadline. All right. There's another item here under the CARES Act for retirement that I want to cover, and that is for plan enhancements. Once again, these are all potential benefits that a plan can either choose to incorporate or not, but if a plan chooses to do so and an individual qualifies, and to qualify, it's the same rules and guidelines as we just talked about for the coronavirus-related distribution. So the either physically or fiscally impacted rules we covered, then there are potentially 3 plan loan benefits that can be available. The first is that instead of the typical cap of only quote unquote $50,000, an individual can take up to $100,000 out of a plan as a loan if they qualify based on being physically or fiscally impacted by the virus. The second key benefit is that normally, once an individual hits a plan balance of $20,000, the amount that they can take as a loan is limited to 50% of their account balance, up to that maximum 50,000. So if they had 20, it's 10. If they have 30,000 vested, it could take a loan of 15. The coronavirus or the CARES Act says that if the plan wants, it can actually pass out the total vested balance, 100% of that vested balance, up through the $100,000 mark, or up to the $100,000 mark. And then finally, the CARES Act says that plans can delay the payments that would otherwise be due from now through the end of this year on current and new loans for up to 1 year. So there are 3 key benefits there for loans. And then finally, and then I'll stop to see if there are any questions on any of these retirement issues and tax issues we've covered so far. But there are, the RMDs are waived for this year. And I think everyone is well aware of that by this point. Just keep in mind that it is literally all defined contribution plans. So all defined contribution plans are eligible for this relief, including inherited IRAs, including inherited 401ks. Now, having said that, it is worth noting that some people took RMDs earlier in the year before they knew that RMDs would be suspended, and they wanted to put them back. And so Congress, or rather the IRS, actually gave us some relief. In fact, they gave us relief several times. The first thing they did was we have our basic rules. We have the 60-day rollover rule, which you could use. We have coronavirus-related distributions, which could be used. But Congress actually came out, and earlier this year came out with Notice 2020, which said that any RMD or any distribution could have been rolled back to as late as January, that from February 1st on could have been rolled back until July 15th. Then after that expired, they came out with a second notice in June of this year, Notice 2020-51, right after the notice we just talked about, which expanded the rules for coronavirus-related distributions. And there, what they said was we would give individuals till August 31st, including, by the way, it gave the ability to for beneficiaries to roll back distributions. And it even said the once per year rule would not apply to those rollovers. It was a really surprising result because in the past, the IRS had said they could not provide such guidance. Well, going forward, we are now past that August 31st deadline. We are no longer in that time range. And so what we need to think about is for clients who did not meet that deadline, but who still have IRA distributions or 401k distributions that they don't want and would like to roll back, there are still two potential ways they can do so. First is if they get a distribution and it happened to be within 60 days, well, they can use the 60-day rollover rule. The second is if they happen to qualify for a coronavirus-related distribution, which we don't know yet for some people, right? There will be more people who unfortunately come down with the virus this year. There will be more people who are laid off or furloughed, et cetera, this year because of the virus. It's unfortunate, but it is reality. And because of that, it is worth realizing that even if someone took a distribution on January 2nd of this year, if they become ill with the coronavirus, for instance, or they are furloughed on December 30th of this year, almost a year later, as long as those two things, the distribution and the physical or fiscal event that qualified them, both took place in 2020, that distribution can be treated as a coronavirus-related distribution. And when that happens, remember, you have 3 years to pay it back, not 60 days. So that could effectively allow someone to roll back a late RMD. And with that, we're going to move on to talking a little bit about the charitable rules in the bill. But before we do so, let me stop here and ask Malik if there are any questions that we should take at this point. Malik?
Yes, I see one question here. It talks about the loan payments. So it says loan payments from qualified plans, can they be deferred for 1 year or through January 1st on the next year?
It is for up to 1 year, right? 1 year from when they would have otherwise been made.
Okay.
Good question.
All right.
All right. Any other questions?
No, that is it so far. Remember, guys, any other questions, you can use the Q&A box and we'll make sure we ask Jeff.
All right. Fantastic. So along with that, the CARES Act also creates a couple new charitable planning provisions for us. So the first one is it's a new above the line deduction for charitable contributions. And this is despite initial ambiguity around how long this would last for. The charitable contribution is for 2020 only, the above the line deduction. And what it is it says if your client does not itemize deductions on their federal return, they can take a above the line deduction for up to $300, provided that they give to the charity in cash. Now, I will say that this provision is simultaneously both a really big deal and an absolute nothing burger, all at the same time. It is both a really big deal and nothing all at the same time. How so? Well, it's a big deal for two reasons. First off, clients hate paying taxes. If there was a way for them to save 11 cents and someone didn't tell them, they're going to be upset. And so certainly we want to educate clients about this, and it will apply to a lot of your clients. Notably, in the past, it was about a third of taxpayers prior to the Tax Cut and Jobs Act that itemized their deductions on their return. But because the Tax Cut and Jobs Act roughly doubled that number, well, the Tax Cut and Jobs Act said that, or it made it so that only about a third of the previous individuals, a third of the third, or about 10% of people today, 10% of taxpayers actually itemize their return. And so with that in mind, many of your clients will qualify for this provision. So the fact that many will qualify and will be upset if they don't know about it is what makes it a big deal. What makes it a nothing burger is that it's a $300 cap. A $300 cap. If you have a client in the highest income tax rate of 37% and they get a deduction of $300, it saves them a whopping $111. Don't get me wrong, I'm not poo-pooing $111. That's, real money. You don't want to throw it away, but if you're making $600,000 plus and in the top tax rate, is $111 of tax savings really moving your needle? Probably not. Now, similarly, let's look at a more modest tax rate, like a 12% tax rate, where many individuals find themselves in. Well, at 12%, what are you saving with a $300 deduction? $36. It's not even enough to go out to dinner in a lot of places, if you can actually go out in the first place. So it is important to let people know, but it's not going to be a material change to their lives. What does have the ability to be a material impact for certain individuals, though, is the second provision, which is a provision that allows individuals to give to charity up to their AGI for the year. They can actually completely wipe out their tax liability by giving to charity. Normally, a cash contribution to charity is capped out at 60% of an individual's AGI, and any amount above and beyond that has to be carried forward for the next 5 years. But this year, we have a 100% limitation for charitable contributions. And you could combine this with other things. For instance, you can give appreciated securities to charity, and that is allowed up to 30% of your income. You could do contributions, cash contributions on top of that to like a donor advised fund. That can be up to 60%. That was increased by the Tax Cut and Jobs Act from 50 to 60. And then this provision is above and beyond that. It says if you want to give cash directly to charities, so you cannot use private foundations or 501(c)(3) organizations, or you cannot use donor advised funds here. But if you want to give it directly to charity, that cash, you can take the difference, and that 60 to 100% of AGI can now be gifted to charity as well in cash. And you can completely wipe out someone's tax bill this year with those contributions. Now, having said that, it's a great thing to do if your client is altruistic and they want to do the right thing and they believe they can support charities this way, and they're just doing it out of the goodness of their heart, right? Which is the best way to give to charity. But oftentimes when people are looking at giving to charity, they're also trying in the back of their minds to do something from a tax perspective, right? Like, I'd like to give to charity, but I'd also like to get the biggest bang for my buck personally when I give to them. And if that's the case, then we probably actually don't want to do we probably don't want to use this provision. We don't want to write off 100% of their income. Imagine your client is in the 33% bracket normally, and they're thinking about doing this. Well, if they give away enough money to write off all of their income for the year and have a $0 tax bill, it does sound pretty cool for someone who normally has to pay, $100,000, plus in taxes to have a $0 tax bill. But here's the thing. If you write off your entire tax bill and you're in the 33% bracket normally, it means you're deducting money that would offset income at the 33% rate. It would offset income at the 24% rate, the 22% rate, the 12% rate, the 10% rate. Do you really want to be offsetting income at the 10 or 12% rate? Things like that. Or is it better to add what would amount to, as a married couple, nearly $100,000, and instead of giving it extra this year, wait 2 or 3 months until January 1st of next year, make the contribution then, and go back to offsetting income at the higher rates? In other words, if you're at that higher rate, paying tax at a 10% rate on some of your income may not actually be a bad deal, right? So something else to consider. All right. With that, let's go ahead and we'll move on to small business provisions here. And we'll start with the big one, which is the Paycheck Protection Program. As many of you are aware, this was the program that allowed small businesses to borrow money from the Small Business Administration, or really from lenders, that is going to be forgiven by those lenders and returned to those lenders by the Small Business Administration. This was the program that had roughly $649 billion allocated to it. And as you can see there, by the time the program ended on August 8th, 8/8 of this year, it actually still had more than $100 billion in there. So while there were dramatic and significant concerns that it would run out of money, some people believing it would only last the second round of funding a matter of days, it ended up lasting all the way through the end of the program. And part of that was businesses were, had already taken it and you weren't allowed to get a second paycheck program loan. The reason it's worth noting this now is that there is still some hope, although it is much less than it was before. And candidly, every day we get closer to the election, it gets harder to happen because neither party wants to give in even more because we're closer and they say, I'll just wait till the election and see what happens. But there is still hope on some hope that we may get another stimulus bill prior to the election. And that might include a second round of Paycheck Protection Program loans for businesses that are really still struggling. For those that took it though, what we need to do now is we need to look at the forgiveness schedule and how to maximize forgiveness. And part of that is even selecting the right covered period. So the covered period was the period of time during which you could spend money as a business on approved expenses, things like payroll costs, things like rent, etc. And to have those amounts forgiven, the money that was spent on those expenses to be forgiven as part of the loan. And initially, the covered period was set to be 8 weeks. Then, as part of the Paycheck Protection Program Flexibility Act, they changed it to be 24 weeks, and we now have the opportunity for businesses to actually opt in to either of those. And so you may say, well, Jeff, why would any business opt for an 8-week period to spend that money when they could have as many as 24 weeks to spend the same money and maybe get more forgiveness? And the answer is that the forgiveness formula, as you can see here on the next slide, oops, excuse me, went the wrong way. The forgiveness formula is actually based in part on how many people you retain on payroll. How many people you retain on payroll. So for argument's sake, maybe you can retain those people on payroll for 8 weeks, but without more money, you have to let them go. Well, there, an 8-week covered period may be better. By contrast, maybe you didn't have enough people you had already furloughed people, you were waiting for them to come back, et cetera, or hours were reduced, and you took longer than the 8 weeks to spend that money. But by the end of the 24-week cycle, you had hired back those individuals and were up and running again. There, you may want to opt for a 24-week schedule. The Republicans have put forth a proposal in their Senate passed bill that individual business owners be allowed to choose any period of time between 8 and 24 weeks. So we still got to keep an eye on this. And because of that, unless you're going to get maximum forgiveness already, 100% of the loan forgiven, it may be best to kind of hold out and wait and see what happens, because we're likely to see more guidance on the Paycheck Protection Program here in the coming weeks and months, if not before the election, then certainly afterwards. Those loans that aren't paid back will have a maturity date of 2 years and an interest rate of 1%, which candidly is still not a bad small business loan, especially for a business that is likely struggling. To have a 2-year loan at 1%, who wouldn't take that, even if you did not, even if you could not have the amount forgiven? Because it's a common question, the update here, some of you may be aware that IRS, despite Congress being very clear, both sides, on both parties, they have come out and said, we intended not only for the Paycheck Protection Program loans to be forgivable if the money was spent on the approved expenses, but that the business could still deduct those expenses as well. Well, the IRS said, we will not allow that. We will not allow the business to deduct expenses paid with a loan that was forgiven. And it is exceedingly likely that that changes. So I know that that's a very common question that I'm still getting in these programs. It is highly, highly likely that we see a change in that before tax season. I would be shocked if we did not see some sort of change in that rule at some point. I do strongly believe that ultimately the expenses that were paid will be deductible for businesses. For other businesses that either have not qualified for a Paycheck Protection Program loan, didn't submit things in time, or simply use their Paycheck Protection Program loan up and still need other resources, the Economic Injury Disaster Loan Program is still up and effective. This allows individuals to get up to $2 million at an interest rate of not even 4% for about 30 years. So basically, a small business that's struggling can get an interest rate on the same terms of like a 30-year mortgage, basically, that's usually collateralized. It's a pretty good deal. And in order to qualify, the business just has to be suffering or have suffered substantial economic injury. There are some interesting benefits here, specifically from the CARES Act. So the EIDL program, or the Economic Injury Disaster Loan Program, is normally is a program that kind of exists in normal times as well for businesses that have been negatively impacted by other phenomena. But the CARES Act significantly expanded it. So, for instance, the CARES Act created emergency crash grants, which have now expired. There's just no money left in the program. The CARES Act also did, though, expand this to be for larger businesses, said sole proprietors could qualify. So some of you or some of your clients who may be struggling now, or look, let's hope there is no big second wave or whatever you want to call it. But if there's a strong resurgence as we head into the end of the year, these are still available through December 31st, and your sole proprietors could qualify as well. The loans that are small, meaning less than $200,000, you don't need to have a personal guarantee on. So if the company goes bust, the loan doesn't have to be repaid. I mean, these are all very significant benefits that are not normally associated with EIDL loans, but were added as enhancements as part of the CARES Act through the end of this year. It's also worth noting that there is a new employer wage credit for businesses that have struggled or been impacted by the coronavirus. In order to qualify for this credit, one of two things has to occur. Either the business needs to be shut down fully or partially for some portion of the year, or you need to have the business see a decline in revenue of more than 50% compared to the prior year's same quarter. Okay, so one of two things occurs. Either the business is partially or fully shut down in a particular quarter this year, or the revenue compared to last year at the same quarter drops more than 50%. So I think an example here will be the easiest way to kind of explain this. So let me go to the next slide here and give you an example with three businesses. So we've got Claude's Coconuts, Brianna's Bananas, and Abe's Apples. And I'll start from the bottom up. You can see the little star next to Claude's Coconuts, and it says, well, Claude's Coconuts was partially shut down in each of the quarters, in each of the 4 quarters this year. Therefore, it doesn't matter what Claude's Coconuts revenue is. Has no difference. They could have a great year, a terrible year, if they are partially shut down. So partially shut down, what does that mean? It could be a restaurant that can't seat people in the office or in the dining room, that they have outside seating only. Could be a business where they can only do business remotely, etc. But it is a business that's partially or fully shut down, and automatically the business qualifies. And again, the credit is up to 50% of wages paid to employees, up to a maximum of $5,000 per employee. That's a pretty sizable credit, especially if you've got substantial payroll. You know, if you've got 10 employees, that could be a $50,000 credit. Now, if you don't qualify because your business was not shut down either fully or partially, you may still qualify because the income of your business was so dramatically cut compared to last year at the same quarter. And so if we look at our second business here in the middle, Brianna's Bananas, we look and we see, well, they never qualify. Brianna's Bananas, actually, of the 4 businesses, has the worst year out of all of these companies if we look to the end at the totals. But because in no quarter did they ever drop below 50%, it's like a mousetrap. You know, a mousetrap, you've got to push enough pressure down on that little spring in order for it to flip over, right? Well, it's kind of the same thing here. You have to have enough downward revenue pressure. And if you don't get enough downward revenue pressure, more than the 50% amount, then you never trigger the credit to swing on. And so that's how this particular credit works. And you can see Brianna's Bananas had bad quarters, but never below $125,000, never broke below the 50% mark compared to the prior year, so never qualified for the credit. Then if we look at Abe's Apples, did better than Brianna's Bananas, but look what happened in Q2. In Q2, it dropped below 50%. And so in Q2, it qualified for the credit. And once you're below 50%, you continue to qualify for the credit until you have more than 80% revenue in a particular quarter compared to the prior year. And that becomes the last quarter. So you look at Q3 for Abe's Apples, they have more than $200,000 of revenue. That's more than 80% of what the prior year's same quarter was. Therefore, Abe's Apples would get that third quarter as the last quarter that they're eligible for the credit. There is a deferral of payroll taxes for everyone else who does not qualify for the primary tax credit. So if you don't get the credit, you can get the deferral still. And the deferral, what does the deferral say? It says that you can defer half of your remaining payroll taxes from the time that this was passed through the end of 2020 until the end of 2021. And the other half of the payroll taxes, the FICA and FUTA, et cetera, can be pushed out until the end of 2022. So that is extremely, extremely significant. And what's even more important for you to know about for your small business owners, your sole proprietors rather, is that unlike the credit, which does not apply to self-employment tax, the employer side of the self-employment tax, or half of self-employment tax, is eligible for this deferral benefit. So what we're really saying is that half of the self-employment tax that would otherwise be paid by someone in the last 3 quarters of this year, essentially, can be deferred until December 31st of next year, 2021. And half of the remaining half, or 25% of the total SE tax, can be pushed until December 31st of 2022. The employee side of that, the other half, will be due the end of this year like normal. Now, President Trump did sign an executive order saying businesses could opt to let individuals defer those payroll taxes as well until next year. But I will share with you that the overwhelming majority of businesses have chosen not to do so. A, because it's an absolute mess to do so in terms of adjusting payroll systems, et cetera. B, it requires a lot of education of employees that had to be done quickly, and there are more important things, frankly, for them to be concerned about right now. And then finally, the third and final issue is that it's not a waiver of the payroll tax. The president does not have the authority, no matter who it is, to create or eliminate taxes. That power belongs to Congress, and more specifically with respect to revenue, the House. And so the president could only defer it. And it just was going to put people in a more damaging position in January of next year, when not only do they have the current payroll taxes that would be due for January in January, but also starting to repay the taxes from this year as well. For your small businesses that ran losses in any of the previous few years, including this year as well, the CARES Act allows the net operating loss, instead of only being carried forward for 5 years, it allows it to be carried, instead of only being allowed forward, it allows it to be carried back for up to 5 years. And that's rather significant because the Tax Cut and Jobs Act had previously eliminated the ability to carry it back. Carrying back those net operating losses can free up cash flow, create tax refunds from the federal government, and help with the business's cash flow, accelerate tax savings. And so there are also some new guidance from the IRS on this. More specifically, if a client does not want to carry back the NOL, they don't have to, but they can choose to do so. And finally, with the last few minutes, there's some other notable provisions I'd like you to be aware of in here. The first of those being that federal student loan repayments are delayed initially by the CARES Act through the end of September. However, President Trump has further delayed the payment of student loans via that same executive order until December 31st of 2020. No interest will accrue, and for the most part, it's not going to penalize people if they want to pay now. So if you've got clients that are paying back loans, or their children are paying back loans, their grandchildren are paying back loans, if they want to do it, no harm, no foul for the most part. But where you absolutely want to make sure that they unequivocally stop paying loans if they haven't already is if they're trying to qualify for the the PSLF, the Public Service Loan Forgiveness Program. That's the program where they say if you work long enough, 180 months for this, 120 months rather, for this private, nonprofit rather, entity, that you are going to be able to have that loan, the balance forgiven. So if you are going to have the balance forgiven, why would you be paying now when there's no interest and literally 100% of what you're paying is reducing your principal, which you won't have to pay anyway in the future? It doesn't make sense. So that's not a good idea. Make sure you contact those individuals. Employers can actually provide another benefit to employees this year with respect to paying for student loans. Normally, employers can provide education tuition assistance of up to $5,250 a year. This year, for this year only, that can be used for student loan payments as well. And then finally, we get to medical changes. The biggest changes to be aware of here that carry forward are that things like FSAs, HSAs, et cetera, can now distribute expenses or distribute dollars that can be used for over-the-counter medications. Previously, those were not qualified to be used for HSA accounts or FSA accounts. Now they can be used. Also, the HSAs can now be used to purchase certain feminine care products, so that's a new rule. And then finally, for some of your older clients who maybe don't want to be going to the CVS or pharmacy, the Walgreens, whatever it may be in your neck of the woods, as much as they did previously, the CARES Act says that a Part D Medicare provider, so the drug provider for Part D, has to offer those individuals a 90-day of supply of medication rather than a 30-day supply, as is normally the minimum requirement. And so with that, I'll pause and see if, Malik, if there are any other questions at this time.
I think we have one question.
Okay.
And remember, guys, I know we're going over just a little bit. We're probably in at 12:05. Want to make sure we field a couple of more questions for you guys. I love how you talked about the details of the special tax treatment of the coronavirus distribution. I mean, that was pretty cool. But I guess if you can, there's one question here. If you can talk about some advice or something where you think might be great for individuals who before coronavirus was going into an office, and now since they working from home, they had to spend all this money to upgrade a home office, or they're using their utilities more and things of that nature, but because of TCJA, they might not get that benefit.
Sure. So it largely depends upon the nature of the individual. If they are if they are a sole proprietor, then they may be able to continue to deduct such expenses as normal business expenses. If they are an employee somewhere and they have no control over what the employer does, well, then that's certainly not something that unfortunately there's not much that can be done. However, if they are the owner of their own small business, or there's some flexibility with the employer, what can actually be done is you can create what's known as an accountable plan. And what an accountable plan, it works particularly well for small business owners who are the owners of their own S corporations as well as the employees. What those owners can do is they can create an accountable plan with the employees. You can be discriminatory there, meaning that it doesn't have to apply to all employees equally. You can just pick and choose which ones you want to do this for. So for argument's sake, if you're the S corporation owner and you have some other employees, but you want to do this for yourself, you can. And what you essentially do is you write a written plan. And there are lots of examples. I've actually written about accountable plans before as well and have examples in those articles. But you just say, we'll reimburse you for these expenses as the business that you incur as an employee on behalf of the business. And that can include home office. It can include things like meals and entertainment. It can include things like, office supplies, et cetera. So you can actually do all that and submit it essentially to yourself, to your business, have your business reimburse you, and that would qualify as a business expense. And those reimbursements also are non-taxable, and to the individual, they're just getting back the dollars that they spent, and they're not subject to FICA or FUTA taxes either. So it's another way to go about that. It's a effective way for some small business owners to get the deduction for their home office anyway.
I think that's pretty cool, because most of us here are probably in that position, right? We're either LLC or S Corp, or we're working for a larger company that we can't go into an office. So I didn't realize it, but that question kind of pertains to probably mostly everybody here on this call.
Hopefully, at least a few of you, yeah.
Yeah, right. We have another question. Might be a follow up. Says, can we just pay for these expenses via the business? Yes. So I'm assuming
you can if it's for the business, right? But if you are paying your mortgage or you're paying your gardener, you're not gonna, you really muddy the water there by making that something that you pay out of the business. It's really a personal expense that you're allocating part to the business. The same thing with like internet or something like that. If you're home, and everybody, this is one of those questions where maybe there's some boundary pushing at times by accountants and whatnot, and you may want to discuss your own tax preparer's view on this and how comfortable they feel. But in general, a business can pay for business expenses directly, but there are certain expenses that, for instance, let's use a car, right, with like a lease payment or something like that. Having a lease in the name of the business can be challenging if you're a small business owner. The leasing company may not want it in the name of the business. It may take more time. It may increase your insurance premium. There's lots of negative things for having it in the business. So there are a variety of reasons that an individual may pay for things personally that in fact are business expenses or can be treated as business expenses. Even miles driven, right? If you wanted to go that route, reimburse yourself 49 cents or whatever it is, 55 cents this year, something like that, for however many miles you drive on behalf of your business. If you're a sole proprietor, it's not an issue. If you're an employee of your own S corporation, well, you're probably going to do that driving personally. You need to reimburse yourself from the business. So it's a little bit of semantics, but ultimately it's what needs to be done in order to ensure that you're compliant and that those deductions are legitimate if you're ever audited.
Okay. And this is a question for me here. So I thought I recall, and I'm just so confused. I think you alluded to it in the beginning about how things are just changing just so rapidly. But I thought I recalled the meals deduction. Was that increased to 100%, or was that shot down in one of the proposals?
Yeah, still working on that.
Okay, still working on that. Okay, all right.
It has not happened yet. It was part of the Republicans bill that was passed in the Senate, but that is not law yet, and it is. It may be something that gets included in a future bill as kind of a trade-off, but there's not a strong push from the progressive side to include that.
Oh, okay. Look at that, and look at here. I thought it passed because I'm just so. I mean, everything is just changing. It
is very busy year. It's keeping us on our toes for sure.
Yes, sir. Yes, sir. All right. So it's about 12:08. We went a little over, but the bucket hammer is here, and he gave us a great presentation. Guys, if you are interested in more materials, the link it's in the chat. It's also on the screen here, and there's additional materials that you guys put on that site that landing page as well too.
Yes.
We really appreciate you guys for coming out and participating. Thank everyone so much. Everyone have a great weekend. If you're in one of the counties, Atlanta, Cobb, or Cherokee, you're coming back and you have kids that are in homeschool, you're coming back from break or you're going to break. So enjoy. Thank you so much, everyone. And thank you, Jeff.
Thank you.